Hey, Larry.
Hey, hey, how's it going?
Good. Thanks for joining
Awesome,
me
awesome.
today.
I am excited. Thank you for the opportunity.
Yeah, this is going to be awesome. I have so many people that have reached out that are super excited for this
Perfect.
opportunity to hear from you. So,
Awesome,
yeah,
awesome. Well, you're setting the bar really high. I guess I got to live up to that somehow, some way.
you better give a couple of good tips for people here, okay?
Yeah, yeah.
So,
I'll try to dig in the bag and see what we got.
amazing. Yeah. So, for everyone that's joining here, this is Larry D. West III. He is a tax strategist and a managing partner with PB Strategies Global Services. And what I wanted to do today, I thought it would be really great to bring him on because he's a wealth of knowledge. I've known Larry now for, I think, a couple of years now, actually. We've worked
Yep,
on a couple
yep.
of projects together. I've got to see firsthand how amazing he is. And I will say, I might be a little biased here, but he might be the best tax strategist out there, guys. Because who else has their face printed on money? Does your tax strategist?
I love it.
So, yeah. So we'll go ahead and jump on in here. I think the first thing that I think people often wonder is what is a tax strategist? How is that different? Is that the same thing as, an accountant or someone who's preparing my taxes? So I'd love for you to share a little bit about what that is and what that looks like.
Yeah, absolutely. It's interesting too because in our space, all kind of names and monikers are popping up to differentiate ourselves from one another. But the best way to describe a tax strategist is someone who, one, is very in tune with federal and sometimes state income tax specifically, okay? Because there are different levels of taxation, but what we're talking about specifically is income tax. Like when we hear a politician say we're going to lower taxes, just like everyone's been talking about in the news lately, tax strategists focus exclusively on that part. So we look at how individuals are making money in their household. We typically want to know how every single dollar flows in, and then we help devise a strategy or a plan to structure that in the most tax efficient way. And so sometimes that means working on what are the deductions that I'm eligible for, on into these are the things that I know that are happening next year. How do I plan for them from a tax strategy perspective now? All the way into the larger estate planning side as you build wealth and get ready to transfer it to the next generation. Your strategist is basically looking at the full scope, the 365 view of your financial world and helping you structure it in the most tax efficient way. Now, what's the difference between someone who does that versus your accountant? That it really comes down to the proactive versus reactive view. Oftentimes we have our accountants who we've been going to for years perhaps that are telling us, hey, thank you for coming to me this year. Here's your tax return. By the way, here's the stuff you should have, would have, could have done. And that's the traditional model. Where the strategist comes in is we're proactive. We're looking at where things are now, where things are going, and how do we prepare for it today. So I would say the viewpoint from a strategist is forward looking, whereas some folks are more historical and backwards looking.
Okay. Okay, so rather than, so if I'm coming to you today and I am, filing for my taxes, um, that would be more of the reactive of like, there's not much you can do because the whole tax year already passed. But for you, when you're working at the tax strategist, it's taking that picture of the past year into account, and then also like, what are your plans for the future? What does this look like? What sorts of things could you do throughout this tax year so that in this
Exactly.
position next year we're ahead of it? Okay.
Exactly. Yep. Yep.
Amazing. So what would you say is a track strategist something that everybody should have or hire? Like, at what point does it make sense for you to be involved or for someone to be looking for a tax strategist?
Yeah, I say in the moment that you start making money and your world starts to grow in complexity, you certainly want a strategist by your side to help you proactively plan for things. Because as some of us have found out, if we wait till the last minute or we wait until the next year, there's almost nothing that can happen. So at the point where you decide that you want to start a business, I think absolutely you want to sit down with your accountant and strategist to talk about what does this mean for you, excuse me, from a tax perspective. At the moment that you're perhaps inheriting property from folks that have been in the family, at the moment that you decide to sell a business, at the moment that you even have stock units, right? RSUs that are granted to you by your job. Those are levels of complexity that carry tax implications. And you want to have your strategist with you at that particular moment to help you plan for it so that you're not trying to recover again down the line. So anytime you're making money, anytime your world grows in complexity, I think it's definitely valuable and worth sitting down and talking to one.
Okay, I think that clears a lot up. What I would love to talk about today and to kind of keep the context around, because I think it's something, there's a lot of, we hear all these tax strategies and all these advantages that people who either are business owners or
Hmm.
real estate investors, there's like no shortage of the amount of deductions or tax strategies or things that you can put into place. I think where there's less, at least education around or awareness around, or maybe some of the things that as a W 2 employee, for example, if you're earning a lot of money, you're working hard, you're earning more money, and then the more you make, the higher the tax bracket goes, and then the more that you're then paying out, right, in taxes.
Hmm.
So what are some things for W 2 employees that maybe they could be looking at that they may not already be taking into account for their taxes outside of just sort of the standard deductions that they might have?
Yeah, I'll just spend a couple of seconds just clarifying some of those standard deductions to make sure that folks maximize. On the W-2 side, the two that really come to mind are going to be the benefits that the employer provides. The main one is going to be the retirement account. So maxing out and funding your retirement account through your employer, especially if they have a match, is free money in a sense, or you can look at it as a raise, one or the other, because as you're making those contributions, depending on if you're doing traditional or Roth, you're getting some type of tax advantage. Either the money is growing tax free and it'll come out tax free, or at least it's growing tax free and you may pay taxes at some point down the line. But the retirement account is going to be valuable. And then you look at your health benefits, specifically if you have a high deductible plan. Using things like an HSA could be really valuable for W-2 folks because it allows you to then use the HSA to do some additional tax planning. Your employer funding that goes into the HSA is not taxable to you. Or if you fund the HSA yourself, that's a deduction for you, so it's not taxable income. So those are some easy things. Outside of that, the lens then turns to ownership. That's going to be the key, and that'll be an underlying theme for everyone, but mainly W-2 folks. You want to have some type of equity and ownership in something, and preferably something that's tax efficient, like real estate, which I'm sure we'll get into more of the details there. Because the key is number one, you can do a lot of securing your future with the retirement planning, but what we know, the reality is it's not going to be enough. You just can't, the way things are going now, you just can't fund it enough for it to be enough for you to retire off of. So alternative investments and ownership is where it comes into play. When you start to do things like real estate, or perhaps investing in other businesses or things of the like, your tax advantage really starts to grow. You start to earn tax-free cash flow. With real estate in particular, depreciation and things like that can help you earn more money, but not necessarily increase your tax. Businesses, or even if you do your own stock portfolio outside of what your employer has, the key is ownership. Ownership is the gateway to effective tax planning. That's the simple way to put it.
Yeah, that makes a lot of sense. So when you say something like tax efficient, we hear that a lot in investing. And in the context, I'll say in the context of multifamily specifically, which is apartment buildings. I've been in this space now for 15 years. So for me, I'm a little biased, want to hear more about, what you think about multifamily. We often say it's very tax efficient and investment. So what exactly does that mean? You touched on depreciation, but if you could unpack that a little bit more so people can understand why an investment like that and how maybe it compares to something else,
Yeah,
like stocks.
absolutely. I think the first place to start there is to understand the basics of real estate being a tax efficient investment in general. And then when we get to the multifamily example, you'll just see how it grows tenfold. So real estate is valuable simply because the IRS gives you a gift, a little bit of a gift, and we call it depreciation. And all that means is, hey, when you purchase a property, the IRS allows you to depreciate, take a tax deduction for a certain percentage of that property every single year for either 27 and a half years if it's residential, like multifamily, or 39 years if it's commercial, like strip centers and things like that. So simple math, You take what you paid for it, divide it by 27 and a half, and you get to take that deduction every single year for either 27 and a half years or the life or however long you own the property, whichever comes sooner. So if we just look at a $500,000 real estate purchase, that's about an $18,000 deduction every year. The way to look at that is you could earn up to $18,000 of rental income and pay no taxes on it because you have a depreciation deduction that's there waiting for you. Now, when it comes to multifamily, $500,000 purchase could be a $5 million purchase, perhaps a $50 million or $500 million purchase. Now that 18,000 all of a sudden becomes 180,000, 1.8 million, 18 million. That's how the power of depreciation when it comes to real estate and tax advantages really works. It literally allows you to earn tax-free cash flow. Now, we know that the investment has to be underwritten appropriately. The deal has to pencil, right? All of those things have to work out. But assuming your investment works out the appropriate way, typically you're going to end up with the tax advantage, number one, of tax-free cash flow. The second part of that is the property starts to grow and appreciate over time. Assuming we did our underwriting correctly, we want the value of the property to go from 500 over the course of the whole period, perhaps to 850,000 or something like that, whatever the number is. The point is, although we take a depreciation deduction, the property actually appreciates in real life over time. Well, now we've grown equity in the property. We're collecting rents. We've got cash-free tax flow, tax-free cash flow, if I can get those words correct, tax-free cash flow. But the value of that property, if we've done our job correctly, it grows over time. That gives us potentially a window to pull equity out of the property. Now, when interest rates are great, everybody was doing this left and right. Interest rates being a little higher, some people have pumped the brakes on it. But the point is, those cash-free, those cash refis or pulling equity out of the property, that's essentially debt. Debt comes to you tax-free. So not only do we have tax-free cash flow from our rent because of depreciation, now we've got tax-free cash flow from the appreciation of the property because we're typically able to pull that money out. Now, most folks will want to pull that out and go buy more, so then you go bigger and you go faster. Some folks pull the money out and run. That's probably not the best thing, but because the more you continue to invest, the more you can grow that portfolio. So tax-free cash flow, you got the appreciation, and then the last part is when you get to the exit. Now you have favorable exit opportunities with either 1031 exchanges or perhaps even long-term capital gains, which is a more favorable tax rate. But the point of all this together is we looked at that example at a $500,000 property. Multifamily just 10x's that because it's a bigger property. You get a bigger slice of a bigger pie. And so it allows you to tenfold those tax advantages.
Okay. And so now looking at exponentially increasing that a little bit here, but how does bonus depreciation or like cost segregation studies, how does that then apply if you're looking at multifamily? And does that change the tax efficiency in any way for a passive investor?
Yeah, it usually makes the tax efficiency better. So what a cost segregation study does is it says, hey, we know that you're going to depreciate this property over 27 and a half years. In our earlier example, $500,000 property, $18,000 a year. But the cost segregation comes in and it says, hey, there are components of this building, which all real estate investors know this firsthand. We know it's not going to last 27 and a half years. We're probably replacing the roof. We're probably replacing AC units, all kinds of things that are usually going to not last the full depreciable cycle. So the cost segregation comes in. There's a set of engineers that go in and they do a very comprehensive study and they say, hey, these are the different components of the building that will only last 5 years, 7 years, 15 years. And so by simple math, if you take something and divide it by 27 and a half versus dividing it by 5 years or 7 years, 5 or 7 years gives you a larger slice of the pie. So the cost segregation allows you to take a portion of segregate a portion of the building cost, change its useful life to 5 years or 7 years, and now you've got a larger deduction. That 18,000 just easily turned into 25 or 40,000. Again, when you go multifamily, that 1.8 million just turned into 2.5 or $3 million of a deduction. And then it starts to grow more and more. Right now, bonus depreciation allows you to take 60% in the current year, 2024. And we know that that's going to go down each year until it phases out in 2026. But regardless, even though we're not in the days of 100% bonus depreciation, I would still take 60% of bonus depreciation, a larger tax deduction, which basically means I get to earn more money for either a longer period of time and pay no taxes on it. And that's the value of those cost seg studies and bonus depreciation. More money, not more tax.
Yeah, love that. So, in the context of like, let's say you want to get into real estate, but you're busy, it's overwhelming, so going and like getting your own single family home and doing your own managing the rentals and everything, you're like, that's just not for me. So instead, you explore something like a syndication. You come to someone like myself who's a fund manager, and I help you get into an investment of multifamily. If that For those types of investments, a lot of the typical hold periods might be anywhere from like 3 to 5 or 7 years. So,
Mhm.
what does that look like for a passive investor to invest in something like that? Like, is there something they should be doing along the way to make sure that one, that they're taking advantage of all the tax incentives that are available as part of that investment? Two, preparing for exit. And then three, if there is bonus depreciation, like, is there anything they should prepare for, like a recapture or something where maybe that full period of depreciation hasn't happened, but they've taken benefits up front? So that was kind of three
Absolutely.
questions, but
No, I love it. I love it because it basically goes through the full cycle: acquisition, hold period, and the exit. So, upon acquisition and throughout the whole period, what we just talked about is perhaps going to be the most valuable thing that many investors will experience. They're getting tax-free cash flow. So they've made a contribution to the fund manager or the syndicate. The acquisition of the building has happened. And then as the building is stabilized, there's going to be distributions that are coming back to them. Typically, these distributions from a tax perspective are usually going to be treated as a return of capital. And that's important because essentially, from the tax side of things, we're returning back the money that you gave us so you don't pay taxes on it, because we know double taxation is not a thing here. So it's a return of your capital. Along that same lines, you're going to get a K1 each year. And this is what many folks have referred to as the negative K1. That's the common way that folks will refer to it. But typically, what you're going to have on that negative K1 is a loss. And it's a loss on paper because of depreciation. Acquired the building, they've done the cost seg study, massive depreciation. That is then shared with all of the participants in the syndicate. So you'll get a K1 that's usually a negative number. Now, how do you use that K1 as a W-2 person? Typically, despite what most folks on social media are telling you, typically as a high income earner, that loss is not going to be deductible on the current year, right? Because you're going to have what are called passive losses, or passive activity losses is what most of us call it in the industry. But that doesn't mean you lose the benefit. What it effectively means is you received your distributions and you're not paying taxes on those. And then you have this loss number that you cannot use right now unless you have other real estate investments that are cash flow positive on paper. Then you can potentially use that loss to offset the income coming from there. Or you have other passive businesses that you're invested in. You can use the loss to offset your business income. Now, both of those, we earn more money but didn't pay more tax. The last thing is you can save that loss and it becomes suspended. And all it means is you bank it and you carry it forward to the next year. That's going to be important because when you get to the exit and you have a capital gain, all of those losses you couldn't take over the years that were suspended now become unlocked, and you can use them to offset the gain. So I know that's a lot, but let me boil it down and bring it full circle. Tax-free cash flow because of depreciation, a loss. I see the thumbs up there. A loss because of the depreciation from the building, and if you have other passive investments, that loss could offset the income over there, or you just bank it and move it forward to offset the capital gain in the future. All of those scenarios are tax efficient. All of those scenarios basically set you up for the theme that we've been talking about. Real estate allows you to earn more money but not pay more tax. There's a reason that most of the wealthy folks have real estate, specifically multifamily and commercial, as a part of their portfolio. It's literally tax-free cash flow in most cases.
yeah, that was a really good breakdown, I think, of all of that. The one question that I have is there anything aside from, so at the point of exit, when someone's coming out, you've got this big influx of cash, that capital event has happened where the lead sponsor has, they're either refinanced the property or they've sold it, the returning, the ideal situation, all of the capital is going back to each of the investors plus the upside, right? Because you've appreciated, you've grown that business, it's increased in value. Aside from it being a capital gain at that point in terms of like that income, is there anything else to prepare to, like, is there ever a scenario in which, for example, all that bonus depreciation or depreciation you've been taking gets recaptured at all, or a passive investor needs to plan some other tax event or something?
Yes, yes. So the concept that we're going into now is what's called depreciation recapture. And for some folks who are just hearing about it, it sounds scary. And essentially what it means is, hey, the IRS is giving you the gift of depreciation, and they allowed you to accelerate faster than what you normally would have, bonus depreciation, accelerated depreciation. So when you sell the asset, there are portions of that depreciation that have to be recaptured, and you have to pay taxes on that amount. Now, depending on the type of property, right? Section 1250, 1245, you don't need to know all those codes, but depending on the type of property, it's going to dictate a different type of tax. Some of that is going to be taxed at ordinary rates, which is basically your regular tax bracket. Some of that has a max tax of 25%, and then some of that is going to be capital gains tax, which is usually going to be 23.8% on the long-term side for higher income earners. So you can fall into either of those buckets. For those on the higher income side, it could be a surprise that a portion of your gain is going to be taxed at 37% versus the 23% that you were expecting. So then how do you mitigate against it? The number one way is you continue to keep the investment dollars rolling. If you rinse and repeat the strategy, hopefully your gain the year that a property sold, one of your syndications sold, you're perhaps invested in another syndication that gives you some bonus depreciation. Remember, we just said those passive losses could offset other passive income. So it could be a scenario where those two marry up. And the key there is, if you want to be tax efficient, keep the investment dollars rolling. The moment you take the money and run, there's almost nothing we can do because Uncle Sam wants his piece, okay? So keep the investment dollars rolling. The second thing is, we just talked about those suspended losses. All those losses that you potentially couldn't take over the 3 to 5 years of the hold, those can help flow through and help offset the impact of the depreciation recapture because it lowers your exposure to the capital gain side of things. So those are two ways that you can be tax efficient. But the third point here, just to bring it all the way full circle in terms of working with the strategist, these are the conversations that you want to have well in advance. If we're in 2024 and one of your syndications sold in 2024, you should be talking to your accountant today, not talking to them in April of 25, saying what you should have, would have, could have done. They could help you plan some things to do now to make sure you can mitigate the tax.
So there's still time for people in the 2024 tax year to still be able to take advantage of some of these things. Is that correct?
Absolutely.
Okay.
Absolutely. Now, the drop dead cutoff, of course, is December 31st, right? Because after the year ends, there's nothing we can do. But this is a prime opportunity. The top of Q4, October, November, these are great chances to do a full review of the year because we've effectively gotten 70 to 80% of the year over and done with. So we know what it looks like financially. This is a great time to sit down, to do a full review of the year, run a projection to see where you're going to fall income-wise, what your tax bill is going to be, all the transactions that have happened, and see what moves you can make in these last 2 months or so to help reduce your tax bill. And then when you get into 2025, start that process at the top of the year. Don't wait till the end of the year next year.
Yeah, that makes a lot of sense. There's so many people around me right now that are quote unquote like shopping for depreciation. So they're looking for investments. They're going around like, hey, I need X amount of dollars of, depreciation or to invest this amount for, for whatever. So
Hmm.
hopefully more people, become aware that they can be more proactive with things and work with people like you who are tax strategists to help advise on that and get ahead of it.
Yep, absolutely. Absolutely.
Yeah. Trying to think. There was one other thing I wanted to make sure I asked you. Oh, I know what it was. So we've been talking about how like the tax implications and the strategies and everything around real estate or investing into those types of investments, what does it look like? Are there any strategies for people who invest? Like we also invest in stocks and, the stock market and all of this. Is there anything else that we can be doing there that's a similar sort of tax shield at all? Or how would you pull in other investments to help with that if there aren't?
Yeah, so with real estate is a passive activity, whereas your stocks are going to be what we call portfolio activity or portfolio income. And so those two things typically don't go hand in hand in terms of offsetting one another. However, what I would look at though, real estate is a passive business. When I use passive, I'm using it in the sense of the IRS because I know there may be some investors on here that are like, There's nothing passive about this real estate. I got to go change a doorknob today." So, so passive in the sense of the IRS, right? Now you look at your investment perspective from what are other passive businesses that I can invest in that cash flow really well. You underwrite them the same way. You never let the tax tail wag the investment dog, but under the sense that you can get a good passive position in a business that's cash flowing, you pair that with a good real estate syndication investment, and you have just created a dynamic scenario where and again, this is for W-2 earners. You've got your salary that's coming in. You got to go to work for that every day. But you've got your real estate syndication where they work with fund managers like you that are doing a phenomenal job. You're getting your returns there and you're getting tax efficient returns, but you're going to get a negative K1 that'll give you the chance to offset some income. That negative K1 can then offset the income that's coming from your passive business. We see this with physicians all the time. Perhaps they have a primary occupation in the practice that they work in, but they're a passive investor in maybe some surgery center out there that they don't participate in. Passive income from that surgery center, passive loss from real estate. They've effectively earned money from two sources and not increased their tax bill while doing so. So I think that's one of the best ways to think about it. But again, underlying all of this, the investment thesis overrides the tax side. We can always figure out a tax solution. We want to make sure the investment is the right one for you.
Yeah, that makes a lot of sense. So definitely not just blindly going out there saying, "Hey, I just heard of these cool tax strategies. I'm going to go buy some real estate." But it's like understand that the opportunities, that your sponsors understand, talk to your tax strategist about exactly what types, because they're not apples to apples, right? In terms of everything that you're looking at.
Exactly, exactly.
Okay, amazing. What else have we not touched on that you think would be important for, in particular, W-2 employees, high income earners, anything else that you think is a good tip or that you would leave them with or pitfalls to avoid?
Yeah, yeah. So I'll leave three. The first of which, and this commonly comes up, is, hey, I ran this real estate thing by my CPA, and they said I don't get any tax advantages. I'm not going to do it. We just kind of went through the whole thing top to bottom, and so I suggest that you ask them to dig a little deeper and talk about how does this really look in your entire world holistically, because what they may be thinking is you're a high income earner, so the passive loss won't offset your W-2, which it won't. But we just talked about the other ways that it could accumulate the losses over time or use it for other passive investments. So don't immediately write it off if your CPA says this won't give you a tax advantage today, because it could give you one tomorrow. And the point of strategy is also planning for tomorrow. The second thing is we talked about working with the tax strategist and things like that. I do want to clarify one thing. A tax strategist does not mean a non-CPA, a non-EA, or a non-accountant. It means it simply means the perspective from which that person works. You want them to be proactive. That's what a strategist is, not reactive. So yes, your CPA can be a tax strategist. Yes, your EA can be a tax strategist. And so just keep that in mind. I don't want folks to blindly go out there looking for, hey, I don't want a CPA, I want a tax strategist. They could actually be both. And then the last thing is meet with them more than once a year. If the only time you're talking to your advisor is in April when taxes are due, or perhaps in October when it's extension time, you're doing it wrong and you're leaving money on the table. opportunities like what we're talking about today with respect to real estate being a good part of the strategy, perhaps some estate planning and things like that. Those are all key things that high income earners need to keep on their radar. And so meeting with your person more than once a year, perhaps 2 to 3 times, is going to be valuable. So those are the three things that I think I'd leave folks with.
Amazing. And how can people find you if they're interested in talking to you or potentially working with you?
Absolutely. Hit the follow button right here on Instagram. Now, they can reach out to us directly on our website. So it is pbsglobalservices.com. There's a nice big button that says Become a PBS client. You can schedule a discovery call and you can chat with our team. And also in the comment section of this live, I'll drop a comment with our contact information, our phone number, email address, and things like that. But pbsglobalservices.com, you can check us out.
Yeah, and I do have to say, definitely follow Larry. I think you're doing it on your personal account as well as on the PB Strategies account. But he has a fantastic series going on right now where he's dropping a tip every single week for 52 weeks of the year. They're all tax strategies.
Yep.
All my friends on here, if you guys are real estate professionals, business owners, Larry has like a million and one things he can, advise you on with that and knowledge that he offers there. So I highly recommend, seeking Larry out and definitely having a conversation with him because he's amazing. We're very grateful for you.
Awesome, awesome. Thank you. I appreciate the time and the opportunity. It's been a pleasure working with you.
Yeah, you too. Well, thanks and have
Awesome.
a good Friday, everybody.
Happy Friday, people.